We have with us GK Joshi, who's the Chief Economist with CRISIL. Welcome to this interaction with Business Standard.
Nice to be here.
I would like to obviously start by asking about your projection, your GDP growth projection for FY23. Now, your projection is 7.8% real GDP growth, which is slightly lower than what the government predicted through the economic survey, which is 8 to 8.5, and at par with what the RBI has projected, which is also 7.8. However, RBI's projections were before the Russian-Ukrainian war and its impact on the global commodity prices and global markets. So what is the rationale behind this growth projection of yours?
Yeah, so we made this projection sometimes in December and have retained it for two reasons. One, I think, is that the Omicron wave proved to be mild, and I think there is some sense that we are now entering into an endemic stage. And so there was an upside. When we made the forecast, we didn't know what Omicron would do and what kind of risks are there. But clearly the risks from COVID are now receding. So that creates an upside to the number that we had forecast at that time. But at the same time, I think we have also seen suddenly new risks crop up. I mean, the geopolitical tensions have mounted to a very high level, I mean, I would say, and I think that's resulting in a lot of commodity and crude prices, etc., going up phenomenally. So that creates a downside to growth. So the call that we took was that we were likely to upwardly revise the 7.8%. So we have now kept it at kept it same. So there are two opposing forces. One, positivity that comes particularly to the contact-based services, which would have suddenly zoomed and which are going to zoom, I believe, I think in 22-23. But that gets offset by the Ukraine-Russia conflict that is going on. And now what happens, we don't know as yet. Situation is very fluid, it's evolving, and uncertainties are huge. So what we will do is we'll currently watch the path of crude, which impacts us most. We have assumed that crude will be in the range of 85 to 90 in the year 22-23. It will first quarter, maybe it will hover around 100. After that, I think it will start coming down, and to give you an average of around 87, 88, I think that's the number we are working with right now. If the oil prices were to shoot up, I mean, beyond this, then obviously we'll have to make suitable revisions to our outlook number. So right now, I think that's the rationale why we have kept it as it is.
Sir, we will come back to your assumptions for crude prices, which is of course more realistic than what the survey had predicted. The survey was looking at $70 to $75 a barrel. So we'll come to that. But first I want to ask you, the geopolitical tensions and the resultant increase in commodity prices. Although the domestic inflation is under control in terms of foods and fruits and vegetables, in terms of food items, but obviously there will be an impact of imported inflation onto domestic inflation. That will all obviously be there. Now the RBI's projection for CPI inflation, for retail inflation, for the next fiscal is 4.5%. And that again was before the recent geopolitical flare-up. So do you think that projection holds anymore? Do you think that projection holds true anymore? And what is your projection? Given the current situation, what do you think would be a realistic assumption for inflation going ahead?
Yeah, so first of all, the central bank's 4.5% inflation, CPI inflation forecast. So that was made before this flare-up. So after that, I think the situation on oil, situation on commodities have actually changed dramatically, and that will have to factor. That will have to get into RBI's recalculation of inflation. So even when RBI was at 4.5, we were at 5.2%. Now what we have done is we have raised our inflation outlook to 5.4% for the coming fiscal year 22-23, which is almost 100 basis points higher than what the central bank projections are. Now, I think what is interesting in this is that you were mentioning about food grains. I think food grains, we are in a comfortable situation. The problem is with edible oils, I mean, which we import. And I think the prices of edible oils have flared. So that is going to put some pressure on inflation. The second, I think, part is, of course, fuel. I mean, that will depend on how the burden of global crude price increase is shared between the households, the government, and the oil marketing companies. For the last 2 months, we have seen global prices shoot up, but there's been no movement either on the excise front or on the passing it to the end consumer. So what it means is that oil marketing companies are bearing the burden, but that's not going to be the situation. My sense is that part of the increase will get passed on to the end consumer, and part of it, I think government will also have to bear part of the burden. It will definitely be inflationary, more inflationary than what I think the central bank had assumed before the Ukraine crisis started. So that's crude commodities. These are one clear risk to inflation. And then the companies have not fully passed on the input cost. I'm talking of corporates. I mean, corporates have not passed on because they have not been able to pass on the entire increase till now. Now, if you look at the IIM Ahmedabad survey on business input inflation, I think that is at the highest level since 2017. So there's going to be a pressure to pass on the input cost increases to the end consumer. Those who can pass on are continuing to pass on. Now, you can ask the question that why, with oil so high, you're not expecting inflation to go beyond this. I think there is an interesting comparison between what is happening now and what happened between 2012 and 2014. During that period, crude was at 110 and inflation was almost double digits. But at that time, food inflation was also double digits, and the core inflation was also close to 9%. So right now we have a situation where fuel is high, but core and food are lower. So that is why you'll not get, hopefully not get to that kind of a situation. But even at 5.4, which has an upside risk to it right now, what it means is that the inflation is likely to stay above the center of 2 to 6%, which is 4%, which the central bank targets even in the coming fiscal year.
To what extent do you think the current commodity prices and the situation will impact government's budget targets, be it revenue and be it other aspects? How do you think that could be impacted? Could that be impacted?
When the budget was announced, I think it was their assumption on nominal GDP growth was conservative. The tax collections were also conservatively estimated. Now, with inflation going up, I think the nominal GDP is certainly going to be higher than what they had assumed. I think just because WPI is also going up, because input costs are rising, and CPI is going to go up from where it was expected to be, I mean, at that time. So clearly, the nominal GDP is going to do well. The nominal GDP doing well is somewhat good for tax collections. I mean, so I would say that you may still end up with what the budget has estimated as tax collection for 22-23. The upside may get, I think, could get crimped. Now the issue is what happens to the expenditures. I mean, the strategy that the budget adopted was that we'll push infrastructure investment. That will create growth, and that will lift all the boats in the economy. But now I think with what is happening currently, your subsidy bill, which you wanted to shrink almost 26% in the budget, I think that is under danger. So the reshuffling of expenditure that government was planning to support capex, I think that will get challenged. Also, if this situation continues, oil continues to surprise on the upside, then I think there is chance that fiscal math will go awry. And so you have two options, either to cut the capex or to raise the fiscal deficit, I mean, from its current levels. So I think they would probably try not to raise the fiscal deficit, so the expenditure will get again reshuffled. So you were trying to cut revenue expenditure and raise capital expenditure. Now that it won't materialize, I mean.
As the Prime Minister is fond of saying, "Aapda mein afsar," whenever there is a setback, you need to find opportunities in it. And this does present opportunities for India, especially in agri products, especially wheat and other agriculture products. So how big of an opportunity is this for India?
I think it's one shining, I think something that was being a burden to us, because carrying cost of holding so much of wheat itself is quite high. So now you're getting an opportunity to export it at higher prices. So it's a positive thing. Depends on how much you export. But your import bill is also expanding massively. I mean, so I think so it's not going to help.
How will that, the rupee situation currently, how will that impact our trade? Import export?
Well, I think rupee, we don't expect too much of depreciation in the rupee this year. This year might close with some March around 76.5 or so. I think that's the average. Next year, I think we are forecasting it to fall further to 77.5. Now I think this is a mild depreciation. Between these two ends, I mean, 76.5, there'll be a huge amount of volatility, and rupee could test newer lows. I mean, that is very likely. I think the issue is whether currency remains weak, weakens much more and stays there for a longer period of time. I think that will add to the imported inflation component. I mean, because your inputs will become more expensive. I just wanted to add a little bit to the government's capex also. See, you have budgeted X amount of money for capex. Now with your input costs rising, you will be able to create less infrastructure than with the same amount of money, because your steel, your cement, everything has gone up, I mean, prices. So there'll be cost overruns. That's another risk for infrastructure projects, I think, right now.
Since capex is the main plank for central as well as state governments to revive the economy after 3 waves of COVID, now the situation is the cost of executing and the cost of financing these infrastructure projects will also likely go up. So do you think capex could be hit and the government would have to spend more on, as you said, the government will have to spend more on subsidies and other welfare measures, at a time when, the cost of executing these projects will increase? Like not just capex, the effectiveness of capex, will that also be hit?
I think that is at risk. I think we'll have to see how, as I said earlier, I think this is a fluid and evolving situation. So depending on how long this pressure lasts, I think if this pressure continues, of course, I think it is bound to happen. I mean, and the cushion that the budget had because of conservative estimates, I think that cushion has disappeared now. I think with the new scenario emerging,
borrowing yields have also been increasing. There's something you've touched upon in your report. So do you think the government should be a little more sort of circumspect in its borrowing program for the coming year? Should it go for a plan where it does not front load as much as it usually does?
That debt management they will do. I think the issue is that quantum of debt is quite large, I think. Which has to be raised this year. I mean, it was a surprise for the markets. I mean, when we saw this borrowing program. And now I think the ordering of where to put, when to, I mean, how to reshuffle it, I think all those activities will continue. I mean, I think the central bank is the debt manager for the government. So I think they'll work out a way which is where the cost of borrowing for the government doesn't go up too much. So, but what is true is that the fiscal pressure is anyway there. I mean, the one is the GSEC yields have gone up, and now there's another risk which was lurking around the corner. US Fed raising interest rates, that is also going to materialize. Crude is high, your borrowing is higher, so yields are going to go up. I mean, RBI has an accommodative stance, but I think despite that, I think yields have been going up, and they may have to change their stance. In that case, I think the yields will have some upside from the current levels, which means the cost of borrowing for the government is going to go up. Now, interest payments are all as a percentage of revenue are already very high, and the debt repayment pressure is also there for the next 4 to 5 years. So there is a lot of, I think, variety of things that will need to be considered. I don't think the borrowing program can be shrunk. So I think there can be some reshuffling of maturity, etc. I think various things which are usually done. I think all that will happen, but the pressure on yields is going to continue. I mean, inflation is high. So as I said, there are many pressure points right now.
The current global flare-up is not expected to continue for some time. Even if the war ends, even the sanctions will remain in place. Two questions leading from that. Number one, on the capital front, after 2 years of sort of shortfall in divestment, in privatization, the government had ambitious privatization plans, and there has been a shortfall because of 2 years of COVID. Air India has happened, but there is BPCL is pending, Concor is pending, Shipping Corp is pending. These are all privatization assets. NINL is expected to happen soon, but Pawanhans and these are pending. And also LIC IPO also there seems to be a rethink in the government because the markets are not conducive. So do you think FY23 also could be sort of a damn squib for the government when it comes to privatization?
See, I think the government was prudent in keeping a lower target for this year, which they can achieve. I mean, they have done homework for many of the projects, but the upside to that target, I think that is a difficult task now. I think so. You can't. But what they have committed in the budget, I think that is still achievable. I mean, even in the current situation, because that was a much reduced target than what they were previously aiming for. I mean, it is achievable. I mean, I won't see slippage on divestment right now. I think that's not what we have factored.
This year's revised targets depend upon LIC.
LIC, I think government's fiscal position this year is not too bad actually. So they I think even without LIC, they may still manage to get the 6.9% fiscal deficit to GDP ratio. But for next year, it will be, I think it will add to the next year's thing. I mean, so there's no major upside, but I think the reduced targets are possibly can be achieved. I mean, that's we are working with that assumption when we do our fiscal math.
In the last budget, I'm talking about the 2021 budget, the FM had spoken because of the COVID situation, the fiscal deficit was expanded and the FRBM targets don't hold true anymore. In fact, the medium-term target of 3% as per the current FRBM Act, that is nowhere to be seen. 4.5 is a more likely target, that the medium-term target the government is aiming for. So do you think, number one, that it is high time that the FRBM Act is amended? And number two, should 3% as a minimum target be gotten rid of altogether? Primarily because it does not suit Indian conditions anymore, and it does not suit a developing economy's realities anymore. The 3% target was something imposed on us by the West. So do you think that the case for a 3% medium-term fiscal deficit target is dead?
I think it will be very difficult to achieve, because even during normal times, I think if you take last 30 years, I think it has fallen below 3% only once. It means that the number of times you slip the target is much higher than you achieve. And so I think you need to relook at this target. But the issue is they should be targeting reduction of debt to GDP ratio over time, because India's debt to GDP ratio is highest in the investment grade countries. The peer group that ratings, I think, which have just investment grade ratings, India has the highest debt to GDP ratio. So it needs to reduce it. And the fiscal deficit target can be accordingly worked out, which is the best way, which balances our need for supporting the economy over the next 3-4 years, and also engineer at the same time a reduction which is credible in nature, so to say. But 3% is extremely difficult. Unless you grow at 9-10%, I think you get that kind of a big kick to growth, then you can achieve 3%. But that 9-10% is not visible anywhere. So I think this target looks unrealistic right now, 3%.
Now, again, going back to the point of that the global flare-ups, its impact will last for a while. US is not, even if the war ends, US is not going back to again importing Russian oil. So, right, so there is a gap. The prices will continue remaining high. So you still feel $85 to $90 is realistic for now?
Well, I think that is the assumption that our oil specialists tell us. What we are doing is we are doing scenarios. If oil is at 100, then inflation goes to 5.8%, for instance. Oil is at 120, then inflation crosses 6% for the average for 22-23. So you're working with scenarios, and depending on how things play out, our assumption is that the flare-up will continue for 2 to 3 months. After that, there will be some softening, and I think for the fiscal year, you probably will end up with the 87. That's the current understanding. That's the current received wisdom. Going ahead, I think, as I said, in an uncertain environment, I think you have to cross the river by feeling the stones. I think if you see oil going to higher levels, we'll revise our outlook. The crystal ball is very, very hazy right now.
Thank you so much for your time, sir.
Thank you very much for having this.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.